Welcome to this L3A conference. Today I have the pleasure to welcome Hans-Jürgen Schmitz, Managing Partner at Mangrove Capital Partners, and Serge Weiland, CEO at Edmond de Rothschild Asset Management. We will cover two main topics today. One is retailization in alternative funds and digitization, also relating to alternative investment funds. So let's start with retailization. Now, retailization is something that in alternative assets we have seen over the last years, sort of penetrating more and more the alternative asset space. And my statement actually is that it has started already with the AIFMD when it came into place in 2012-13 roughly, so pretty much almost 10 years ago. So talking about this, Hans-Jürgen, you are one of the major players in alternative assets, in particular venture capital fund. Is that something that you can confirm is a topic or is an issue? Do you actually see that also in your funds?
Well, thanks for the question. That's already a tricky one to start with. So, ever since we started ever since we became a registered, fully authorized actually AFM manager, we wanted to go more towards retail investors. I couldn't say at this point in time that the environment that the AFMD provides, or the framework, is actually really applicable or well adapted to retail investors. I guess it depends how you define retail investors to some extent, because there are minimum thresholds that still need to be met by these investors. I'd say there's still a way to go, even for if AFMD were to become a welcoming environment or framework to host and integrate more the retail investors into alternative funds, whether these are, by the way, venture capital funds like ourselves, or whether they are private equity funds of all colors, or infrastructure funds. I think the basic challenge and at the same time the opportunity from the industry's perspective, at least, to broaden up to retail is there.
Coming to you, Edmond de Rothschild actually has alternative funds. It also has retail funds, classic long-only equity bond funds. Do you see an increasing hunger also from retail investors for alternative assets?
Yes, well, definitely. I think, as you rightly say, I think we are a private bank. We are an asset manager. As an asset manager, we also manage an increasing portion of private assets. So it is roughly now a third of the asset base managed by the asset management side of the business. Historically, I think private clients have always allocated to these strategies. We've done it typically through feeder funds, so also under the AIFMD framework, be it SIFs, probably more recently also using the RAFE regime there to set up feeders. But definitely, I think, especially in the low interest rate environment we are in, also with the discretionary mandates, the kind of typical balanced portfolio, which was incorporating 60% of fixed income. That bucket now needs to be allocated somewhere else. And of course, alternatives is a natural choice there. And we see it. I mean, private clients, a number of them are also previous entrepreneurs. They like when they like being involved in the real economy. So they are also looking for getting closer to what's happening. They like stories about turnarounds, investment opportunities. So very clearly that's a strong trend.
So you mentioned feeder funds as one of the means to get indirectly into the main private equity venture capital, whichever fund. I would assume also parallel funds would be an option. Discretionary accounts are a way into this. Now we've been having this LTIF fund, the European Long-Term Investment Fund, which is for infrastructure in particular, which has been taking quite a while actually to fly, but it also seems to be picking up now, right? Is that also because people are getting more hunger? You think it's more because we do have an issue obviously with yields in the low interest environment? Or is it also that people are maybe eventually sort of more keen on doing something good to infrastructure, environment, solar energies, renewable energies? What do you think? Is that a trend that is going to hold also for the future?
I think that the LTIF regime in particular, I mean, we haven't used the LTIF regime as an asset manager. We have seen a few LTIFs as a fund service provider though. We've seen it primarily in private debt. It's being used by some players also from Southern Europe. I think that the LTIF, the issue with the LTIF is the diversification requirements, the cash buffer requirements that need to be revised, I think, to make it a viable option as a retail product to invest in private assets. I mean, we see what we use as an asset manager. We tend to use the local regimes in France, for example, or in Spain. To build parallel funds indeed that will enable us to distribute to non-professional investors, because those regimes exist, the FPCI in France or the FCR in Spain, whereby you can actually set up the fund under a fully registered AFIM, and you can distribute that to your private investors without having to have the discharge, the opt-out regime. So that's been used, but we have big.
By the way, just a question: would there be a minimum threshold for those kind of investors, or no longer? I mean, there's thresholds obviously depending on which legislation we're operating in. 125, 50,000. I'm sometimes getting confused myself. But in this new way you mentioned, is there a threshold?
I think there is 100,000 threshold, 100,000 euros threshold, but it's easier to market. And anyway, I think the typical, we're talking about retailization here, but we're not talking about a 5,000 euro ticket, or we are talking about wealthy private clients, and I think that's also a word of caution. I think that it would be, probably not wise from the industry to push people with tiny savings into illiquid products, because we know that if you want to be serious, you have to look at a long time horizon.
That would be the advantage also, I guess, of, let's say, a parallel fund or a feeder fund which holds a certain amount of cash as well, in order to allow for redemptions, for example, premature redemptions, which normally doesn't marry very well with close-ended, in particular, venture capital private equity funds.
That's true, and the more you go to the very risky side of things, i.e. venture capital, the more this is true. Now, maybe to put it into more in a broader or even macro context, and I'm using some of the experiences we have in venture capital, at least as a backdrop. I think there is 10 years out, 20 years out, and certainly beyond, there's a very, very big need and at the same time desire to tap into this humongous pool of private wealth that is already existing and that is doubling. I saw a statistic actually today, that from 2016 to 2025, and I guess that was a global one, and don't nail me for the number, it goes from 80 trillion to 140 trillion, so almost doubles. Now, a big portion of that obviously is invested or locked into real assets, whether these are companies, enterprises, your personal real estate. But there's still a very, very big pool that is seeking financial returns. And I think both the mutual fund industry, as much as the private or the alternative investment industry, have yet to unlock that potential. And of course, the drive from the customer side, from the investor side, is very evident. We have a low to no interest-bearing environment, and that is probably there to stay for an unpredictable period of time. And they're looking for returns. And at the same time, if you look at the demographics of it, that's another interesting perspective that sometimes asset managers or articles about asset management give you, is if you look at what they call it, the next generation, the Gen Z generation, or the millennials even. So any of the people from the age of 20 to 50 at this point in time, probably more to the lower end, they are a lot less risk averse than probably their parents were. Now, is it because they were more on the receiving end as they inherited money, or they made money themselves early on? So they're a lot more, let's say, open to alternative investments as a means to get a higher return. And I don't know whether 100,000 is the right threshold, whether we could go down to 50,000. I don't think we will answer that question today. But the access to the asset class should be easier, as opposed to having to go through questionnaires and opting in or opting out and getting confused as to what it means. Much like in the mutual fund industry, you don't get those. You just, I mean, obviously with MiFID, etc., you do get more complexity around what you have to declare and be aware of. So I'm not advocating, by the way, that investor protection should go down, but we should somehow find ways to ease the access to that asset class, which will be increasingly in demand. And if I look at the big private equity or alternative managers, all the names that you know, whether it's Carlyle, KKR, Blackstone, BlackRock, BlackRock is actually more than just an alternative manager. I think most of them, if not all, already start developing products that are really targeted towards that audience. And they're making it increasingly easy, but very obvious also, that they want to tap into this pool for the very obvious reasons of returns. And actually, interestingly, and that's maybe one of the things that, at least in Europe, from a private individual's perspective, leads to a longer learning curve versus the Anglo-Saxon markets, is some statistics seem to suggest that while the returns are higher, the risk, or the volatility at least, is not necessarily higher. So as you said, you can't live on a 60% bond portfolio anymore. So you take that down and you put it into alternatives to whatever proportion, and it actually doesn't necessarily increase your risk profile. That's what I'm reading. Obviously, I'm in venture capital, so I'm not going to talk about risk profiles here, because it is a very high risk.
But maybe a thought that comes up following your comment is what I've seen, witnessed this now with a couple of organizations, especially private banks. I think it has taken the private banking industry also some time to come up with an complete or an approach encompassing also illiquid assets in an asset allocation. Because traditionally, your private banker will look at asset allocation only with equities and bonds. And that's it, and that's how he will define based on your needs your ideal asset allocation. The journey to incorporate illiquid investments into that asset allocation was actually quite long, and actually what I witnessed today is there are not that many organizations that are able to really include alternatives in a global asset allocation for a wealthy individual. And then there's providing the building blocks to feed that illiquid portion, because the reality is a number of private banks have started setting up fund of funds, which I still believe is a very clever way to access private markets, because you want that level of diversity, especially if you start tiptoeing and starting with those strategies. But I think even there is room for improvement. We've seen fairly costly structures in the fund space. There's always there are a few other challenges that go with it. But I think it's the combination of a broader asset allocation, including alternatives, and working on that, and also making it easier to understand for private individuals. And potentially also including other aspects that are not typically included in an asset allocation, looking at your real estate ownership, or then you start opening up a can of worms.
What you do see also from time now is what I think we haven't actually discussed, because for the moment we're looking more at the high net worth individual side, and also we obviously see smaller institutions also venturing into alternative assets via fund of funds. But there are like crowdfunding opportunities, there are platforms where people like me, who probably sort of come and put a couple of bucks in there, who do want to get into the large funds, you named a couple of those ones, and will never get into those ones as a high net worth individual, yes, but never as a mini small retail 18-year-old. And I think those crowdfunding obviously is a different story, but there are platforms out there where basically, like a feeder fund, money is being collected, and I guess a certain AML KYC light done as well, in order sort of to have their data somewhere. And then the money is collectively invested in the larger funds, the institutional funds, the CVC, KKRs, Blackstones, and so on and so forth. That seems to be something which is still fairly new, but developing fairly quickly. Do you actually see that also from a VC point of view? The platforms.
I mean, I don't. Yes, I do. Absolutely. The question, whether the answer is in principle yes. Probably less so on the VC side, although we see a few VC fund of funds. They're not that many, I guess. There must be a lot more fund of funds into private equity, for example, and into private equity real estate. I think first of all, one of the things that I sometimes hear is that whenever you propose a fund of fund, and I'm not proposing that to any of my investors at least, is, oh, that's expensive because it's a dual layer of fees that I have to pay for. So this is true. But if that's the only way to get into an asset class that gives you a 10-15% promise on returns versus, and I'm not making any statements of what is a minimum acceptable return, even if it's 10% and you have a 0% interest environment, so why would you complain about a dual stack of fees? Now, probably as you said, the industry itself saw this maybe as a welcome opportunity to add some fees, and hence some of the structures were maybe, from today's perspective, excessively expensive. That has to come down, and it will come down, and one of the key, say, levers to bring it down is one of the next subjects, which is digitization. Exactly. But to finish up, and yes, there are examples where structures are being set up and managed appropriately that allow retail investors, I don't know from what size onwards, to invest into a venture capital fund of funds. Or somewhat, actually it's a venture capital fund. Our crowd in Israel, it's a name that resonates because they've been in the press recently, does exactly that. And on the private equity side, there's other examples of platforms that allow you to get access as a retail investor, again with a minimum threshold, into private equity funds that otherwise you wouldn't even have access to, right? So this having access to something that before you didn't already has a value and possibly a price. But digitization, if I take examples such as Moonfair and others, they help, at least on the front end side, to make that path into the asset class a lot easier, including, by the way, You talk about KYC and all the regulatory requirements, which of course you cannot ignore. You have to say build them into the user experience, I would say, and that I'm saying this as a venture capitalist, so the user experience that allows you, and I've had that experience personally also, to seamlessly and painlessly in front of your screen make a placement into such a structure. Now, how they're managed in the back end is a different question. That's actually an interesting one maybe for our second subject, which is the digitization. But just to illustrate one thing, you mentioned private banks have been trying for a long time, or asset managers, to devise products to that audience. I would venture and I would challenge that the disruption in this field will come from startups. So people who have no allegiance to a history or an existing structure or existing way of thinking. And there's a few examples of those. There's a company, and I'm not an investor, so full disclosure, a company called Exporo in Germany, and probably beyond Germany now. They are offering fractional interest in real estate portfolios, for example. Mm-hmm. So that's one way. Another one called Scalable Capital, and there's others which are digital asset managers. So within 3 or 4 years' time, they have gotten to multiple billions of assets under management, mostly from people who are, I'm not sure what their minimum criterion is, again, I'm not a customer either, of this one in particular, let's say 50,000. But they've been able to amass interest from a large number of customers in a very short period of time to get assets under management that traditionally would have taken 20 years to get to, or at least 10. So this is where the disruption will come from, and part of that is the digital way of accessing those products, and that will be maybe an introduction or a bridge to the next topic, unless you have another question for
no,
for the
I
former
think
one.
I mean, it brings a lot of issues that I think still need to be cleared, and I think one of the question apart from the AML KYC is actually how to manage this numerous accounts, small accounts. I'm just as an administrator, from an administrative point of view, the horror of having to deal with hundreds and thousands of investors, the classic way we do it now, makes me shiver, basically. But I think this is also something that is probably going to change over the course of the time. But then again, also, because we have small investors, the AML KYC, because everybody just keeps so little of the assets, that the impact of one investor is obviously far less high than if you do a classic private equity fund with 10 or 15 investors. But I think it changes sort of in total also the way, also on the administration side, how this has to be dealt with. And I think that actually brings us to the second part, which is the digitization, which I believe we had, when we discussed this formally, we had a couple of discussions on where we are, for example, in Luxembourg nowadays with the digitization. And you were saying that years ago we had that topic already with digital assets. And I was like, yeah, but that must have sort of gone away. And you say, yeah, and maybe you can bring this back a little bit, sort of where we were at the time, a couple of years ago, with the digital assets, and then where we are today, which is not the same, but it looks like we are sort of going back into that direction via the back door somehow. Hans-Jürgen, maybe you can just explain in a couple of some simple words what digital assets actually are.
Well, now you open a Pandora's box here.
Okay, great.
Well, let's say there's two very different things, digitization on the one side and digital assets on the other. So if I start with digital assets, I think from a venture capital perspective, it's something that becomes a reality nowadays. That is more and more assets, and an asset could be a real estate asset, a share in a company, or just any other piece of art, okay, is going to be represented in the future, or what they call tokenized, into a digital code. And this is broadly what I would, for the purpose of that conversation, consider a digital asset. Where it's relevant for Luxembourg and also for us as an operator in Luxembourg and elsewhere is that we probably will see more and more of those assets that, for example, we traditionally invest in, which are shares in companies, will be represented not by a contract, a piece of paper, but by a digital representation of what used to be a piece of paper, for the very evident reasons of efficiency, fluidity, liquidity, so fungibility, and well, there's obviously challenges, that is safety and security. How would you store this asset? How would you make sure that it's always yours and protected? And that's where the challenge will become for administrators, particularly custodians, whether they are here in Luxembourg or elsewhere. This will become a reality. More and more of assets will be tokenized, mostly as a store of value, not so much as a functional currency, i.e. a tradable currency, or for purposes of trading. But they ultimately have to be tradable as well. Again, if you have a piece of art or you have a stake in a company, you eventually want to sell it again, or as long as you don't do it, you want to make sure that it is really yours. That's where depositories will have a challenge. And we've had that 4 years ago, going back in time. We did start making blockchain-based or decentralized finance-based investments, tokenization-related investments 4 years ago. Now, they haven't taken up immediately. I think there's a second wave now that's coming, and that second wave is a lot stronger than the first wave probably 4 or 5 years back. And so I would see this is coming. And if I use, for example, again, the name of Explorer, and I'm not making any publicity here around it, I think one of the things they're trying to do, and that's where retailization comes into play, is they're trying to enable fractional ownership to retail investors who otherwise, through tokens, fractional ownership in a piece of land, in an apartment, in any piece of real estate that otherwise the individual retail investor could not afford. But tokenization will enable such a fractionalization. We're still in the very early innings, but we see some of the, at least the venture capital-backed projects that are going into this direction. And again, the question will come: if you're authorized AFM like we are, you get a token. What do you do with it? How do you store it? And 4 years ago, we had no answer from the market. We haven't tried it since. But I venture, if I again went out today and offered my custodian banks a token as opposed to a piece of paper, there would still be quite some questions and discussions around it. But that will be coming. Now, technology is a key component of that, because it drives a lot of elements, such as, again, who's your customer, where's the money from that token has been acquired with, etc. So those will be the challenges that I see for Luxembourg, but any financial center in the context of digital assets. And there will be this will be the future. There's absolutely no question about it now. 20 years, 30 years, 40 years, maybe the horizon. But we better get ready, and those who are ready, they will have a competitive advantage. But here we have a representative from the custodian bank.
I was just going to say, we have
others,
somebody
so
with a custodian bank.
How would they look at this? I don't know.
No, I completely agree that I think this is the direction of travel. Now, I think there has been a lot of talk around it. We've seen a few proof of concepts of tokenization of real estate assets here and there, or tokenization of company shares.
Even in Luxembourg now.
But I think the reality is today we haven't seen really a big project being implemented. One project that caught my attention was the announcement that Azimut made, because they tokenized private debt from Italian SMEs, but with they didn't do it, I think, as a as a gimmick. It is really with the intention, and it is driven by retailization of creating, first of all, making those tokens fairly accessible, easily accessible. They provide a wallet. They provide a wallet to their end customers, to their financial advisors, and that is, for me, an example where you have a network of clients and of advisors behind. So you're a fairly strong reach, or a broad reach of a client base, and the ability potentially as a second step to create a secondary market. Because for me, tokenization without a secondary market is no different from what we know here in Luxembourg of a Euroclear or Clearstream security. We've known tokenization for a while through securitization. I mean, securitizing a private equity investment or real estate investment that has been done for a number of years in Luxembourg. That means also you can book that asset to your bank account, you can transfer it to another bank account, but it's useless if that security or that token you create, if you have not standardized its features. So you need also to think of, how do I make it comparable? Can I create the metadata that is required to create a secondary market for people to start trading in that token? So that raises the question of data management, and can we build infrastructure to exchange data, and what infrastructure and regulation is needed to create a secondary market? And that is a question that is being addressed also by the European Commission these days, and I think there's more probably simplification, hopefully, of regulation that will come. Because currently, if you take it by the book, you need to be regulated as an exchange, as a multilateral trading facility, which is very heavy-handed if you want to start creating a small secondary market for your tokens. So, I mean, these are all, I think, explanations why it has not really picked up yet. But I think if we see, for example, also retail platforms come in, from the internet world, that have that global reach of client base, that can, if they start providing access to private assets, tokenized private assets, they would have an immediate pickup and could, create a portfolio or an app where it is easy for you to follow your investments and perhaps to start trading with their friends. I think that will drive the demand for tokens, and that combined, of course, with also regulation making way for those initiatives. And but it goes back to our earlier point. I think there is a need, because our savings cannot all go into the quoted markets, the public markets, because we see the price bubble out there. It's
very volatile.
It's very obvious and very volatile, and so we need to create those other or another avenue for also retail savings to
Sorry, go ahead.
No, I was just going to say the advantage is obviously that the core problem of alternative assets, that it's not liquid, would be solved basically through the secondary market, where you can, as an investor, also sell your tokens, I guess. So the original problem that we always have with alternative assets, that you're basically stuck with an investment for 10, 15 years in a fund with that maturity, is basically broken up.
Well, that would probably be taking two leaps at the same time, which probably is a bit, in my view, a bit optimistic. I think the first level would be, and I look at it now from a financial center perspective, whether it's Luxembourg or any other financial center, is to be open to what's coming. I draw a blank. I don't know how open you consider, for example, the regulatory framework or how accommodating. Is it today already in the wake of the surgence of digital assets? Do you see Luxembourg being prepared for this broadly, or at least being mentally engaged in this or not? I don't know.
I think we are fortunate enough to have access or easy access to the regulator in Luxembourg. I think there has been a word of caution, or also clearly expressed by the CSF when it comes to cryptocurrencies, where it's
which are two things that shouldn't be mixed because
exactly.
they're very different.
I think that, and sometimes I think we tend to kind of mix the two concepts, but. There's certainly some room for improvement overall in Luxembourg, because some other financial centers have being quicker to adapt certain or make way for initiatives. But I think that Luxembourg has always been also of the view that we can not only create a local national framework that doesn't make any sense because our internal market is too small, so we need to in a way work at a European scale and try to use European directives, the European framework for developing something that's that is more difficult to do. If you're a larger country, you can of course then decide things that apply to your local market. But Luxembourg doesn't have that luxury. So
well, Switzerland, and I'm not an expert here at all, but seemed to have positioned itself at least higher up on the, let's say, notoriety level or scale when it comes to digital assets at large. It
started already with cryptocurrencies a couple of years ago.
And of course cryptocurrencies are part of that, and just to that, clearly there is absolutely no comparison or mixing to be done between cryptocurrencies on the one side and digital assets on the other. Other than obviously the commonality of it being code-based, as is Bitcoin, as is Ether, as is some of these other currencies that I can't even enumerate. I think there's thousands of them. I think that has its challenges, Bitcoin being the store of value that everybody looks at. But I think like in many financial systems, it's the trust that will eventually lead to Bitcoin being worth what it is. I mean, people ask me, well, do you think it's worth $60,000? I don't know what it is today, $60,000, or how can it happen that it went from 5,000 to 60,000 in like 4 years? I think it could go to 200,000 if there's as more trust, not if, but as more trust is being developed around this currency or other currencies as a store of value. And some of the big banks offering, for example, ETFs on the basis of a bundle of cryptocurrencies is part of that trust building, because you would probably, use my example, I would not invest directly into any of those currencies, but I would go to a bank XYZ, who is a well-known bank, who says, I'm taking care of the buying and selling, I'm taking care of the custody, don't you worry, you will not lose the code, which is one of the horror scenarios. So, but here we're talking about digital assets and digitization in the broader sense of the industry. And to that, there was maybe one of the other dimensions you already alluded to, which is that if we take retail investors, or we embrace them in a more, let's say, proactive fashion, they will cause a problem at the back end. You can easily build a front end that allows me to sign up and provide my KYC document and all of that. And I can tell you by experience, it works pretty well already. Usually it comes, as I said, from the disruptors, not from the incumbents. But then it still remains a problem at the back end. Instead of 100 investors, you have 10,000 investors. And now you have to provide data, you have to provide information, you have to provide reporting. And this is where you will not survive unless the back end is being digitized. And I don't know, I could probably give examples of what that could mean. There's at the very least, there's a cloud-based infrastructure that has to work, because these tools, they need a cloud to be performing. They can't be on-premise anymore. At least that's not the conventional way of doing things. So that's just purely on the infrastructure side. These tools they probably will not come out of the incumbents themselves, whether they're banks or asset managers or administrators. They will come from, again, disruptors from the tech world. And then they have to be adopted and accepted as new paradigms of working, which includes obviously questions around GDPR, questions about where are your data, generally speaking, what kind of data do you make available to whom. I mean,
also what you need to track actually, as a custodian you normally have to track all the cash flows. To what extent are we, example, if we have all these retail investors, you're not going to track all the cash flows if investor A in a secondary market sells its tokens or shares.
Well, let's not even say
that is,
yeah,
well,
so I get that. I think that's why I said let's take one
Mm.
step after the other. I mean, here again, back to reality or to the floor. We're talking initially not even digital assets. We're talking just me subscribing to a fund as a retail investor, and I have 10,000 other investors in the same fund, and I would now have to manage, or you would have to manage all the subscriptions. Let's not even talk about redemptions or secondary markets, although redemptions for the mutual fund industry are obviously dime a dozen. And this is where probably some of those technologies will even find an early adoption, because there you have the velocity of those trades, or of those of the need for velocity. It'll be rules-based, exception-based treatment of those flows. You talk about cash flows. It'll be machine learning and AI that has to be applied, and will only give you the exceptions to the rules that you set, the rules that are being trained constantly, and that give you a dashboard that will only flag to you what's not, or what's not within a certain boundary, and the rest you will have to somehow, of course, test and audit, but then ultimately trust that the systems will, or these tools will provide, let's say, for 90% of the what's going on, the right answer and the straight-through processing, and for the 10%, you then really use your intelligence as an organization to check, double-check, verify.
But this is already a reality that, for example, the large retail banks have to deal with. And this is the digitalization process that some of them went through already, not completely finished. I think probably the next step is indeed to create those market infrastructures or digital identity that, more and more, as a client of those banks or those platforms, you get identified once, and you update your documents only once, and then it gets disseminated.
Right.
And I think we're gradually getting there. I mean, there are a number of those platforms available, but they are not interoperating yet. They are still, national solutions,
silos, as we call them,
that operate. But I think to a large degree, that has already been the issue of the retail banking business, and we now see also these worlds converge a little bit. The fund industry, the private asset industry, the retail banking, or what is the retail banking of tomorrow? Will it be Facebook or Amazon or I don't know, certainly.
It will probably less likely be some of the incumbents, although unless they really transform themselves. I mean, I'm always flabbergasted. I'm personally not a fintech investor, at least not a B2C fintech investor, because we're shying away from these very large amounts of money that are being used to deploy, to invest into those disruptors. But if you look at the number of clients that they have, or client relationships in the banking world and the insurance world, and probably there's plenty of other examples, the number of client relationships that they have been able to create from zero, from scratch, in like 3 to 4 years is mind-boggling. Who would have thought? I would have not believed that this is possible. And we see it now. I just saw something today in the energy world. Similar thing. Right? Make it digital, make it fungible, make it easy to access and maneuver around. They will have millions of customers in probably 3-4 years' time, and that will be, and they have their problems right now. I'm speaking of some of the names that sometimes go through the press about regulatory compliance of neo-banks, neo-retail banks. They will overcome those. But they have the agility, both on the technical side, but also probably on the process side, to overcome these hurdles and become as competitive and as compliant at the same time, more competitive and equally compliant than some of the incumbents. And that will be a big challenge. And sometimes maybe the asset management industry should look across the fence and get inspired by what's happening in some of those alternative say verticals or business models that are around investment management, right? Whether it's retail investments, alternative investments, whether it's ultimately token investments, right, or crypto investments.
Yeah, I guess also if I just look at the landscape here in Luxembourg of transfer agents, I think there's also, because it's a very traditional way it has always been done and dealt with from AML KYC over redemption, subscription, capital calls, distribution. So let's say heavy for the moment that the solution for the moment I think are more sort of outside Luxembourg to bring in other sort of means of dealing with the issues, and one of those were actually these platforms that we mentioned before. Yeah. But at the end, I think we do agree that the technologies need to also arrive here at the transfer agents in order to cope for the new demand also from let's say younger people, retail clients.
Maybe the challenge that we have seen with our book of business as a transfer agent, if I can speak about that a little bit, we have a portion of our of our transfer agent book is pure retail business, and so that's a way of dealing with it, with certain or specific processes and needs, and that you can digitize. It's fairly easy, and those solutions now exist. Then you have the more structured wealth. The private wealth clients that you typically have use structures. It can be trusts and the likes. Yeah. And then you have the institutional investors, and those three segments are very different animals. Also in terms of identification of how you store data with respect to these clients. And so far we haven't really found a single solution across the board, and that is a big challenge. And I think for most of the administrators in Luxembourg, because we all more or less have that diversity of breadth of business. Some are more focused on one or the other, but so of course this industry is maturing. I mean, the solutions are maturing, getting more sophisticated. It started in the retail space, and now we can see platforms that really address properly the institutional side of the business. I would say probably the one segment that I still see as a most difficult is the private wealth. Okay. Because that's the solution. There are no solutions, at least that I'm aware of, that cover that part of the business. Probably because historically that segment is looked after by the people, incumbents, the bankers,
the people. No, they're all probably best of breed solutions. I'm not sure whether an all-encompassing solution or the vision of that, like we had in the older days of banking systems, it has to cover all, or most at least, of the processes. I don't think that's going to be the future, at least not in these agile technologies that you need. So there will be probably specific best-of-breed solutions for the transfer agent on the one side and the custody on the other, or even subsets. But since the open data infrastructure is there nowadays, APIs are a commonly accepted way of connecting applications to a same set of data. I think technically or technologically that shouldn't be such a big challenge. I think from my side, as a closing remark on Luxembourg, I think as long as we all, the operators, the service industry, the regulators, politicians, recognize that I mean, on retailization, it's going to come. So if you want to be relevant as a financial center, you have to embrace that and make it surmountable as a task for asset managers, among others, to create new structures that will access to assets that are catered more towards retail investors. Same applies to the technology. We need to be open to that, and whether ultimately, I'm still making probably a very provocative statement, whether ultimately my data are in the Luxembourg cloud, or which probably is the least safe, all things considered, or European cloud, or ultimately somewhere else. I don't think I mind that much, but I say this as an asset manager in a very specific industry, which is just venture capital. So, and I understand other industries have more significant challenges for that, but we need to be open to that as well. Otherwise, that business will go somewhere. I mean, you mentioned yourself, there's other places that have been further along in their thinking and in their openness to welcome. Can't judge.
But I do think that, in particular, since COVID, so everybody was thrown into more digitalization, that everybody is more open today, because we've been thrown into this from one day to another, to move more towards digitization. And I think this will also foster and probably push also retailization to a certain extent. If I see how rigid we were all a couple of years ago, because this is just the way it's been done, and there's no way of moving around. And nowadays, suddenly everything works in a digital type way, even for administrators, custodian banks, etc., etc. It does make a big difference.
If I look at this, I mean,
I think, indeed, for me, the shift of mindset was to, before, when there's no urgency to do it, people tend to say, it's risky, we have to look at the data security and the regulation and the regulators.
And suddenly it works.
And I think the COVID crisis forced us to find solutions. And I think people realize that solutions were actually there, and we could find some and we could make it work. And so
that's good.
I think there is a certain shift. I see it, in our organizations, also vis-a-vis people who their job is to protect data, is to protect us against intrusions, or these. But they were forced to find solutions, and I think they entered into a different
switch
their way of thinking and way of looking at things. So I have to say I'm an optimist as well, but maybe to your point, Hans-Jürgen, I think what I see in Luxembourg, we ought to really also work together as an industry, because there are so many different components that we need to assemble, because I think our industry and the servicing industry is now more and more about also assembling these solutions that are here and there in terms of digital solutions.
Let me ask you a question, maybe
rather than reinventing the wheel. So it's
when you're thinking about solutions and outside of those who you may develop in-house, which is always an alternative, obviously, to buying solutions from outside. If you had to buy them, what's the chance that you find them built here in Luxembourg? I mean, as a financial center, we should have all the knowledge, right? So it should attract companies, and this is with my maybe rather narrow view on innovation, right? We're a fintech hub.
So do you have the answer?
We're marketing ourselves. My experience from a little further, because I'm not in the selection process, but we are trying to digitize ourselves without even having the need from a customer perspective, because we only have a handful. But I think we need to be more agile as an organization towards our LPs, to our investors, within our organization, with our service, with our delegates and service providers. I think 1 out of 5-6 solutions that were on the list came out of Luxembourg, which is already good that they have one. Oftentimes you find 0. And one of the things, the point I was trying to get at, is I know that the sandbox approach is being used in the UK and probably other places, in this case, from a legal and regulatory framework, to say, okay, here's this little box. Startups or companies who are developing technology can stay in the box, and we as a regulator, among others, will just look at it and give you the opportunity to try and test a lot of things, which certainly in the UK has created a lot more, let's say, innovation for those tools and others. I understood that that principle was not withheld in Luxembourg because it wasn't considered a mandate or need to have that sandbox that allows fintechs to develop, fintechs in particular, because we're talking about the financial industry, develop tools that ultimately would be used here and elsewhere, but built here. So that I find a little bit surprising from a technologist or technology investor perspective. So we look elsewhere, unfortunately, even including for our own tools. Anyway, that was my closing word to digitization,
yeah,
but we
on
will.
On that note, I think we chose...
There's an opportunity
there is an opportunity. I think we're still a long way to go, but I think it's an exciting thing to do over the next years, for sure, and I'm sure we'll see a lot of change coming in the next years or so. I think we're on a good way anyway, but let's see if we in Luxembourg can also develop more solutions. And I think on that note, thank you very much.
Our pleasure. Thank you, Anja, for having us. I hope the...
Thanks for the intervention.
L3A takes a little bit of... has a few takeaways from that conversation.
So do I. Thank you very much.
Thank you.